just started snowing. I didn't even see this. That's going to bug people. But you know what? It says shine bright, so I'm going to leave it. We're going to talk today about a story out of CNBC, and it's from a Zillow economist. Zillow has absolutely lost their mind. Now, we've seen Zillow be wrong before. Remember when they all started buying houses and then everything went crashing down for the company? I haven't even read this story yet, but I already know Zillow's lost their mind, so I guarantee you I'm going to pick it up. But just in the title alone, it shows you how they've lost their mind. It's entitled, "Don't Blame the Fed for High Mortgage Rates," says Zillow chief economist. So this is someone that went to big schools and became a chief economist. They're supposed to be the smartest, the head, right? The biggest. I know there's multiple chief economists in the company, but just so you know, this guy's a moron. And I'm just saying that from an investor standpoint. Somebody that wants to make money, has made money in real estate. The real culprit and his predictions for 2024. So I can't wait to dive into this amazing jewel of knowledge. Real quick, there's, I think about half of the spots are taken now for up till March 1st for the real estate crash master course. It's $24.99. If you want the link, it's down below. And the first group coaching call is going to be around the end of February. So here we go. If you didn't, and just, you know, you don't need any fancy courses and group coaching to be a success in real estate. All right. You don't. Just start studying, start saving money, getting ready for this. And seeing morons like this, I mean, chief economist, and I haven't even read the story yet. This should show you how you're going to win in real estate. Don't be like the masses and follow chief economists like this. If you didn't get in on the housing market when interest rates were low, you may feel like you missed the boat. The average rate on a 30-year fixed rate mortgage is currently about 6.7%. That's down from 7.8% in late October. Yes. Don't worry, it's going to go lower and then it's going to go a lot higher. But way up from 3% or so we saw in 2021. Oh, you got to be kidding me. There's no article here? Oh, you idiots. Here we go. Continue reading. I had to hit the continue reading. See, I've never read this story. For the casual observer, the culprit behind the climb is obvious. Starting in early 2022, the Federal Reserve began to hike its benchmark interest rate, which caused the rates on all sorts of debt to climb. Oh, really? You got to give me this guy's name? Orphy Divinyungai. You can't make this up. See it right there? Yeah. Here we go. Orphy Divinyungai, a senior economist at Zillow, would beg to differ. At a Zillow-sponsored event in October, he said that the Fed's sway on mortgage rates was overstated. That's weird. I sort of thought like when the prime rate goes up, it causes the banks to have to borrow money from the Fed at a higher rate. And if they want to give it to us in mortgage, they've got to raise their amount because of margin. Oh, I'm an idiot. I'm not a chief economist from Zillow. Check this out. All right, here we go. He said the Fed's sway on mortgage rates was overstated. His thesis is don't blame the Fed. Well, Orphy, are you getting paid by the Fed to lie? Because that's actually how it works. But stand by. He's a chief economist, so we should listen to him. Make it caught up with, oh, it's the name of their news media. Make it. Caught up with Divinyungai in the new year to chat about the economic drivers of mortgage rates, where he thinks rates are headed in 2024, and whether or not it's worth considering getting a mortgage with an adjustable rate. Oh, I can't wait to hear this crap. Divinyungai, because that's his name. Mortgage rates, this is what he said. Mortgage rates tend to follow the 10-year treasury yield. Yeah, duh, we all know that, but the 10-year treasury yield follows the Fed. We also know that very often there's a spread between mortgage rates and the yield on the 10-year. No duh. Okay, copy. Good job promoting this guy. Most of that spread is due to uncertainty about a number of factors in the market. When it comes to the yield on 10-year treasury, I can't stop. This guy's a moron. All right, let me explain something real easy. So do I believe that the 10-year goes against the grain of the Fed sometimes? Yes, when there's fear in the market or when there's exuberance in the market. Okay. But here's the whole point. When interest rates are low and the Federal Reserve has created an ultra low environment interest rates, the 10-year goes down. Why? Because that's sort of business. That's where money is created at the Fed, right? When the Fed starts to tick rates up, the 10-year goes up. Over time, when the 10-year goes, or the Fed rates go down, the 10-year does drop. Because the banks and investors are going, where do we park our money? We park it with the Fed, park it into bonds. All right? So they do move alongside of each other, even though the time difference is different. There's a delay to the upside of the 10-year in relation to the Fed rates and to the downside. All right? There's a delay in time for investors either panic in or chill out. How's that? Does that make sense to you guys? All right. So he talks about, but he says the 10-year, when it comes to the yield on the 10-year Treasury, which is kind of like the main driver of changes that we see, that depends on current inflation, economic growth, but also expectations over future inflation and future economic growth. What has the picture looked like recently? Before he tells you, I'm going to tell you. The Federal Reserve just had to come out in a meeting and say, we're going to pencil in 3 rate cuts. And what happened to the 10-year? It dropped. Why? Because investors believe the Fed. So weird. The Fed, even without adjusting their rate lower, they conned the bond market into dropping their rates. Isn't that weird? See, you're not going to hear that from a chief economist because he's too busy being a chief. And these guys tend to be wrong all the time. It's like Jim Cramer. Inflation came down in the past year from 9% year over year to about 3%. We've seen some cooling off in the labor market. Are you high? Are you high? Cooling off. We're laying, I can't even start. We've seen a normalization in rent growth and price growth in the housing market. We've seen wage growth cooling. All of that tells me the U.S. economy is cooling. All right. Okay. If you want to go real mellow. See, this is how these chief economists duck. They like to go real vanilla because they don't want to ever be called wrong. Unless, I guess, you're, the National Association of Realtors chief economist, David. I don't remember his name. He's an idiot. He's been wrong all throughout 2005, 2007, 2008. He's still chief economist. He's dead wrong now. But they want to be vanilla. They don't ever want to put their neck out and say, hey, look, this is what I see coming. But let's see what he sees coming. So he says, so the Fed is not involved. Mortgage rates don't really depend on the Fed. They depend on inflation expectations over future inflation and economic growth. That's absolutely 100% horse crap. When I came out and I made an announcement in April of 2020 saying that inflation was going to start ticking up in 2021, April 2021, I said lumber is going to crash in price because real inflation is going to increase in food and all kinds of things starting in September of 2021. Mortgage rates did not move up. As a matter of fact, mortgage rates did not start moving up until January of 2022. Because in December of 2021, the Fed came out and said, we're going to get in control of this inflation thing, like 5 months from now, though. And that's when slowly rates started to tick up because they knew the Fed was going to start raising rates. So banks front ran that whole market. He says, in advance of economic conditions, if you are expecting the U.S. economy to fall into a deep recession, then you might actually go out and buy bonds. You might go out and buy these long-term treasuries. That pushes the price of treasuries higher because there's an inverted relationship between bond prices and yields. That's completely correct. A strong economy is to blame, he says. It's consumers buying and business hiring. It's a strong and resilient economy that's boosted inflation to a 40-year high. That is 100% not true. What happened was the country was told to go home, stay inside, and we'll give you some money to do it. And people started speculating in all kinds of markets, from cryptocurrency stocks to buying furniture to buying homes. So the next question is, so if we expect the economy and inflation to cool from here and the Fed cut rates, should we expect mortgages to fall? He goes on to say, like I said earlier, mortgage rates don't necessarily respond one-to-one with the Fed policy rate. So a decrease in the Fed policy rate, he must have been in high school when I was investing in real estate because he doesn't know how this works. Because when I started investing in real estate, the Federal Reserve was slamming rates down on the backside of the dot-com bubble. Housing prices weren't necessarily dropping. They weren't also going up. They were sort of stagnant. but they were diving rates down so that people would be encouraged to borrow money, leverage it, and invest in markets, whether it be real estate, stocks, things like that. And so just so you know, as a real estate investor myself in the year 2001, and there's not a lot of people out there on YouTube or X or any of these platforms that were investors back then. There's not a lot of people, just to know. You have all these new people with new money that don't know the difference between a Fed rate hiking cycle and a lowering cycle. They don't know how it affects the markets, okay? They've only been in ultra low rates, ultra easy credit expansion sort of, phenomenon. They don't have any other idea. They're about to all get smacked in the face pretty soon. So at that time when rates were going down, the Fed funds rate, mortgage rates were nosediving, and I was refinancing and buying more homes I was just using the equity in my first home to buy 14 homes. All right. So he says here, it's only if the U.S. economy is in a lot of trouble that investors believe that the economy could go into an economic downturn or contraction, that we would see yields decrease further from the current level, and that we could see mortgage rates fall further. So that's actually not true, because as the Fed lowers their rate, bond investors end up buying the 10-year, because the 10-year usually sits a little bit above where the Fed is in a hard time. As the Fed's lowering rates, those 10-year bonds have a little bit more of a return. And as more people dive into that market, yes, it drives the rate down because there's more buyers. All right. He says the yield on the 10-year typically falls about 1 percentage point between the last rate hike and the first rate hike. Exactly what I was telling you. I agree with him in this. It's that time differential. Okay. The difference in time. So they do correlate with each other. As the Fed rates are dropping, bond rates are dropping, but let's say this one's at 4 and this one's at 5. When this one goes down to 3, this is going to be a 4. Okay. Do you understand how I hope people are getting this. So this is what he had to say. This is what blows my mind. This is chief economist at Zillow. Okay, here's the question. If we don't think rates will fall much further this year, what about actual home prices? This is what he says. New construction is still doing very well. That's 100% wrong. Lie. I went into Toll Brothers and Lennar with my wife the other day, and I love looking at new homes, getting decorating ideas, because I love still, remodeling homes. And my wife, we went to 5 builders, and every single one of them had new inventory for sale right now. Like, it's already been built. Nobody's put a down payment on it. Nobody's put a deposit on it. You can move in right now. So that's a sign, right? Not a strong economy. Went to 2 custom builders that are small companies, and they were super expensive. And I said, we got to go to Toll Brothers. We got to go to Toll Brothers. Or Lennar. My wife can't stand Lennar because it's just like there's no upgrades. And I don't know if you know this, the lady like upgrades. And so we walk into Toll Brothers, and they give us the whole spiel. Okay, here are the models. Here's the price list. Like, all right. And my wife's like, all right, I'm going to go look at the first one. And I go, and again, we're not buying. We're looking, doing research. Well, she wants to buy. She's going to watch this. She's shaking her head. I go, wait, what incentives are you giving? Oh, and the bad salesperson goes, I think they were hoping that you didn't know. And they go, oh, God, we're giving $30,000 in upgrade incentives. My wife turns around, what? And then I go, okay, how about financing? Oh, yes, there's an additional $20,000 if you use our loan company. I'm like, all right. We about to start to walk out. I turn around and I go, what about cash buyers? And they go, yes, there is an incentive. I don't know about that one because there's not a lot of them. And they go, let me get back to you, but there is an incentive if you pay cash. So what they're telling you is we're going to take money off this house, period. Okay, so the new home market's not doing well. And just, where I was looking in the country is actually a really strong market still because of the outflows from California, the panic. Okay? All right. Try going to Georgetown. Go Google Georgetown, Texas, and go look at Lennar's or Toll Brothers website, and then contact them and see how much they're going to take off of that house. They're hurting. They're hurting bad. So, but the head of Zillow chief economist says that new construction is doing really well. Especially in the single family sector, I expect to see all of those homes that are under construction coming on the market. Well, no freaking duh. Like, do you realize how dumb people are? This is the chief economist. I expect to see all those homes that are under construction to come to the market. You idiot. But this is the chief economist. That's like saying, I do imagine that all of the homes that are not painted, that are currently under construction and ready for paint, to be painted in the future. Like, this is the dumbest crap I've heard in my life. This is why, you know, if you're swimming against the current, you're gonna win. And for all the morons that go, well, yeah, but even a broken clock's wrong twice. I'm like, yeah, and I'm right 100% of the time because I'm betting on the 2 times. I'm gonna take your house. And I'm not gonna feel sorry. I tried to warn you. I'm not gonna feel sorry. Look, I could go on for ages, but the point is that just because the word chief is in front and you're an economist, first off, you listen to economists, you should run like crazy. You just need to go against the flow. And what do you do right now? You don't need to buy some super expensive course with coaching. You don't have to do that. Seriously, don't. Like, if you're not there, don't do it. I would suggest that you just save money. And I get this question all the time. Well, when's a good time to buy a house? I'm like, when you can afford it. But see, everybody's like so scared. Like, I just want to make an extra buck. I'm like, if you try and time the top, try to time the bottom, you're going to fail every time, 100% of the time. I have failed every time in that. I just want to buy the bulk of my purchases on a down cycle, knowing that when I wait and I'm patient, I'm going to sell them all to the masses at the next bubble. So right now you have homeowners that should have sold a while ago that are freaking out. They're going to have their chance in the sun right now this spring because rates are coming on a little bit because the Fed faked everyone out. And then that's your last shot. Called a dead cat bounce. You have your peak, dropped in prices and sales dropped, and there's going to be a little bit of an uptick in the spring, not only because of seasonality changes, but because of rates coming down a little bit. And then get ready because the price is going to start to fall off a cliff in the fall. Again, even worse than what we saw this last year because rates are going to go higher. I know it sounds crazy because the Fed hasn't fixed inflation, and they haven't fixed it because they broke it because they're in charge. So whatever the chief economist at Zillow says, Fed's in control, but they're not in control. I hope you got that. If you guys want the link, half the slots are available. I limited it to 50 people for this whole month of February to get into the real estate crash master course. I'm going to give you no excuse to not be a success after this. After 1 year of being through this, you will save 5 times the cost of that course, or you'll probably make a lot more than that because this is what I do. I love this stuff. I love teaching people how to be a success. And remember, the bread and butter, the big money maker in real estate, it's not in 10 plexes, 20 plexes. It's good for cash flow if you just want to park money and you don't want to do a lot of work. The big money, the big returns during a real estate crash are your single family homes and maybe duplexes. If you want to get into fourplexes, that's cool. But your big bread and butter, because you're going to be able to market it to so many people and you're going to have more of a profit margin, is going to be your single family home. So start thinking about that. Even condominiums when they go into REO status, okay, or real estate owned. Hope you got something out of this. Thank you so much. If you want the links down below, and if you don't, just save money, make money, and just put it away right now because you're going to be really happy in a year from now, but 2 years, you're going to be scooping up stuff like crazy. All right, that being said, the Real Estate Ninja is out.